Hey there, investors. Welcome back to another deep dive into the world of finance. Ever feel like the stock market's a wild ride, like you're on a roller coaster that never seems to end? Up one day, down the next. The constant fluctuations can be both thrilling and terrifying. It's enough to make your head spin. The unpredictability can leave even seasoned investors scratching their heads. Trying to predict it can feel like a fool's errand. Many have tried and many have failed. But what if there's a theory that explains it all? A way to make sense of the chaos? Enter the efficient market hypothesis, or EMH. This theory suggests that the stock market is, in fact, not as random as it seems. Buckle up, because we're diving deep into the world of EMH and whether fancy AI can crack the code. It's a journey that promises to be both enlightening and challenging. Think of the stock market as a giant puzzle. Each piece represents a bit of information, a clue to the bigger picture. Everyone's trying to find the missing piece, the secret formula to unlock riches. It's a quest that has captivated minds for generations. But the EMH argues that all the pieces are already in place. The market, it says, is always in equilibrium. It says stock prices already reflect all available information. Every bit of news, every financial report is already factored in. This means no sneaky tricks, no insider knowledge can give you an edge. Sounds crazy, right? But hold on, there's more to this theory than meets the eye. Before you throw in the towel, let's break down the EMH into bite-sized pieces. Understanding it could be the key to mastering the market, because understanding it is key to navigating this crazy market, especially with AI shaking things up. The intersection of technology and finance is where the future lies. Get ready to learn how the EMH affects your investment strategy and whether those brainy machines can truly outsmart the market. It's a fascinating world, and we're just getting started. Okay, let's break down this EMH thing. The efficient market hypothesis, or EMH, is a financial theory that suggests it's impossible to beat the market because stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. Imagine a giant, bustling marketplace. That's the stock market. It's a place where millions of transactions happen every second, and each transaction is a reflection of the collective knowledge of all investors. Now picture millions of investors, each with their own piece of information, buying and selling stocks. These investors range from individual traders to massive institutional investors, all trying to make the best decisions based on the information they have. The EMH says that all this information, news, rumors, financial reports, gets factored into the stock price almost instantly. This means that the price of a stock at any given time is a true reflection of its value based on everything that is known about it. This means you can't beat the market because there are no undervalued or overvalued stocks. Every stock is priced exactly where it should be, given the available information. The price you see is the correct price based on everything everyone knows. So, trying to find a hidden gem or an undervalued stock is essentially a futile effort. Now, the EMH has three flavors: weak, semi-strong, and strong. Each of these levels represents a different degree of market efficiency. Don't worry, we'll tackle each one. Understanding these levels is crucial for any investor who wants to grasp how market efficiency impacts their investment strategy. Think of them as levels of market efficiency. The weak form suggests that past trading information is already reflected in stock prices, so you can't use historical data to predict future prices. Weak EMH says, you can't predict future prices based on past performance. This means that technical analysis, which relies on historical price and volume data, is not effective. Like, just because a stock went up yesterday doesn't mean it will today. The market has already adjusted for that information. Semi-strong EMH claims even public information won't give you an edge. This means that fundamental analysis, which looks at financial statements and news, won't help you outperform the market. And strong EMH? It says even insider info is useless. Even if you had access to confidential information, it wouldn't help you beat the market because the market is that efficient. But here's the kicker. If the market is truly efficient, does that mean your investing strategy is doomed? Is there no hope for anyone trying to outperform the market? Can anyone, even those fancy hedge funds, consistently outperform? Or are they just as likely to fail as the average investor? Hold that thought, because we're about to explore each type of EMH and see if it holds up in the real world. We'll dive into real-world examples and case studies to see if the theory matches reality. Not so fast. You might think that past prices can help you predict future returns, but that's not always the case. Let's start with the easiest level. Weak form EMH, or efficient market hypothesis. This theory says, forget about technical analysis. It suggests that all past trading information is already reflected in stock prices. You know, those charts with squiggly lines that supposedly predict the future. According to weak form EMH, these charts are essentially useless. Weak EMH says those past price movements are meaningless. Imagine flipping a coin. Each flip is independent of the previous one. Just because it landed on heads 5 times in a row doesn't mean the next flip is guaranteed to be tails, right? Same with stocks. Each price movement is independent. Past performance is no guarantee of future returns. This is a fundamental principle in investing. Weak EMH argues that stock prices follow a random walk. This means they move in an unpredictable manner. They bounce around based on new information, making it impossible to predict short-term movements. News and events drive these changes. So don't waste your time trying to time the market. It's a futile effort and can lead to frustration. Now, does this mean technical analysis is completely useless? Not necessarily. It has its place in the investing world. While it might not predict short-term fluctuations, some argue it can help identify long-term trends or market sentiment. This can be valuable for certain strategies, but don't bet the farm on it. Always be cautious and consider the risks involved in any investment strategy. Next up is semi-strong EMH. This level says that all publicly available information is already reflected in a stock's price. Think company announcements, earnings reports, even news articles. So, if you think you found a hot tip in the Wall Street Journal, think again. Semi-strong EMH says everyone else has already seen it, analyzed it, and the price has adjusted accordingly. This means trying to gain an edge by poring over financial statements might be a waste of time. The market has already processed that information faster than you can say dividend yield. But here's the thing. Semi-strong EMH assumes everyone has access to the same information and interprets it the same way. But we're humans, not robots. We all have biases and emotions that color our judgment. Section 5, Strong Form EMH, even insiders can't beat the market. Now, for the most extreme level, Strong Form EMH. This one claims that absolutely nothing, not even insider information, can give you a consistent advantage. This means even if you're best buddies with the CEO or have a crystal ball showing the future, you still can't beat the market. Strong Form EMH argues that any advantage from insider knowledge is fleeting and will quickly be arbitraged away. Now, this level is highly debated. After all, we've seen cases of insider trading where individuals profited from non-public information. However, these are often illegal and come with severe consequences. Strong Form EMH suggests that trying to gain an edge through illegal or unethical means is not only wrong but also ultimately futile. The market is too smart for that. Section 6. The rise of the machines AI and ML enter the trading floor. Hold on to your hats, folks, because things are about to get really interesting. We've talked about the EMH and how it claims the market is practically unbeatable. But what happens when you throw artificial intelligence and machine learning into the mix? Imagine an army of super smart computers analyzing mountains of data in the blink of an eye. That's AI and ML at work in the stock market. These powerful technologies are changing the game, and even the EMH might need a software update. AI and ML can process information far faster and more efficiently than any human. They can spot patterns, identify trends, and make predictions with incredible speed and accuracy. This has led to the rise of algorithmic trading, where computers make trading decisions based on pre-programmed instructions. Section 7, AI's edge spotting patterns and predicting market trends. So, how can AI and ML potentially outsmart the market even if it's supposedly efficient? Well, remember how the EMH assumes everyone interprets information the same way? AI doesn't have that problem. AI algorithms can analyze massive datasets, including news articles, social media sentiment, and even satellite images, to identify patterns and correlations that humans might miss. They can detect subtle shifts in market sentiment or predict company performance based on alternative data sources. Moreover, AI can adapt and learn from new information in real time. This means it can adjust its trading strategies as market conditions change, potentially giving it an edge and exploiting inefficiencies that humans might not even notice. Section 8. Can AI outsmart the market? The jury's still out. So, does this mean AI is the magic bullet that can finally crack the code of the stock market? Not so fast. While AI and ML offer incredible potential, the market is a complex and constantly evolving beast. Remember, the EMH is based on the idea that any new information is quickly reflected in stock prices. Even with AI's speed and processing power, it's still limited by the availability and accuracy of data. Moreover, AI algorithms are only as good as the data they are trained on. Biases in data can lead to biased predictions, and unexpected events can throw even the most sophisticated AI models off course. Section 9, join the debate, can you really beat the market in the age of AI? So there you have it. The EMH says beating the market is a long shot, but AI and ML are shaking things up. It's a fascinating battle between human ingenuity and technological advancement. What do you think? Can AI truly outsmart the market, or will the EMH prevail? Share your thoughts in the comments below. Will AI be the ultimate stock picker, or will the market always find a way to stay one step ahead? Let's keep this conversation going.